Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. It is Wednesday, February 3rd, 2021. You're tuned into our YouTube channel. Thank you very much for tuning in. If you like this video, of course, please give us a thumbs up and consider subscribing. So today I'm going to talk about seasonality. Now, seasonality is a distant second to price action, and a lot of times it doesn't work. But sometimes you get price action aligned with a seasonal pattern, it can have a little bit more power behind that signal, if you will. In other words, a breakout with bullish seasonality is more bullish. A breakdown with bearish seasonality is a little more bearish. So we're going to look at the best and the worst months since 1950. And then I'm going to show you how seasonality is subject to change by comparing two 20-year periods. And then we're going to look at weekly and intra-month seasonal patterns. So Stock Charts has a really nifty seasonality tool. You can see here, this is the free charts page, and there you can see seasonality, and you just put in your symbol and click go. So here I am on that seasonality chart, and it goes back 5 years by default, but we can take it back 20 years here by dragging that slider, and I will click and drag it over. So we've got 20 years of seasonal patterns for the S&P 500. And if you want to go back in time a little, you can slide that slider over, and you can see we've got 1990 to 2009 now. So I'm going to look at the last 20 years, and we can see here what I like about this Stock Charts one is it gives you the percentage of months that actually closed up or down. And that's that number there at the top. And we can see right away the two best months are April and November by far. 79% of the time, these months close higher. And you can see here is the average gain over those 20 years. So on average, November was up 1.9%, and April was up a whopping 2.3%. Now, the thing about averages, you do have to be a little bit careful because, you can have a couple of big months like down or up that can really skew an average. If you look at February here, you can see it's up 60% of the time, but it's flat basically over the last 20 years if you take every February. And if you go back and you look at as we'll see in a couple of charts going forward, that there were some big declines in February over the last 20 years. And so that can skew that average gain loss indicator. Looking at the other months, I would say that, you got to get into that near 70 to have something of significance, because you can see there's a lot of 60, 58, 58, 58, 63, 63. That's kind of middle of the road. On average, the stock market is up more than it's down. But once you start getting to 68%, like May and July and December, then you have some significance. And if we put it all together, you can see there's a stretch here, November, December, and then January is not a good month, and it wasn't this year as well. February, March, not good months. But then we get into April, May. So you've got basically a 1, 2, 3, 4, 5, 6, 7 month stretch that's pretty darn good. And yeah, you got some off months, in June and in September. But it's interesting, January is one of the weakest months overall. So I want to take this back a little bit further and look at seasonal patterns over the last, say, 70 years. And then I'm going to break it down into a couple of different segments here. But if we look over the last 50 years, you can see 3 months stand out as relatively weak months: February, June, and September. And this is the average gain loss over the last 70 years for each month. So these three are net negative, especially September. And then you look at May, it's barely positive, and August is barely positive. And then everything else is performing pretty good. We've got 100 as the center line there. And so anything over 101 is really outperforming. And again, we can see April and November standing out. December as well. And then if you go back to 1950, January is actually a pretty good year. So, with a lot of things regarding technical analysis, it depends on that time frame you are using. Now, if we look at another period, I'm going to look at the period from 1980 to 2000. And this is 20 years. And we can see, again, here's the 101 level. And if we kind of draw a line across there, we got a lot of months exceeding that 101 level, which means they were up on average more than 1%. We can see September was still a bad month during that 20-year period, but every other month was positive except for August, and that's where the dog days of summer got coined, I guess, was in the 80s and 90s. But if we look here, we can see again November, December, January big. February was actually positive from 1981 to 2000, and then April good and May good. So we're again seeing this stretch from, say, November up until April, maybe into May in that period. But now I want to look at the last 20 years, because this is the thing I want to emphasize about pretty much all things regarding sentiment, regarding seasonality, and correlations. Things do change. They are subject to change. Relationships do change. So here's what the picture looks like from 2001 until now. So look at February. It's a big red one. If I go back, look at 1980 to 2000. It's a big green bar, one of the better months out of the year for a 20-year period. So you go into 2001 and you say, all right, February is going to be a strong month. And then boom, the next 20 years, it's not a strong month. And if you go back on the chart, you'll see February 2001, the S&P 500 was down 9%. February 2009, it was down 11%. February 2020, it was down 8.4%. So those big declines really affected the average for February. And the same is true in June. If we look at June 2002, down 6%. June 2008, down 8.6%. June 2010, down 5.4%. And then in September, it gets even worse. In September, you had 4 declines greater than 7% over the last 20 years. So it's a very different looking chart, but 2 months stand out and hold the test of time, November and April. And those 2 months are by far the best months for the stock market. So if you're going to get any kind of seasonality going, you definitely need to include those 2 months in your strategy. If you're seeing a breakout in late March, that's going to be really bullish because April is coming around the corner. If you see a breakout in October or a reversal in October, that's really bullish because November is around the corner. Of course, that's what we saw. We saw the market bottom in late October, breakout in early November, and had a banner month in November 2020. But I guess we're all focused now on what's going to happen here in February, maybe March. And, this has been a pretty weak 3-month period over the last 20 years. So here's a monthly chart of the S&P 500 going back 20 years. And you can see basically a lost decade there when we went sideways after the dot-com bubble burst. And then we had the big breakout and we had the monster bull run into the highs in 2020 and now 2021. So we're up like 400% from these March 2009 lows. And along the way, you can see there are some big declines. But look at this. You had 2 huge advances here in 2020. And I'll put my cursor on here, or I can hover over the chart, and we can see where those are. Okay, so I got my cursor on, and lo and behold, it's April and November. Double-digit gains in those 2 months. And so that is helping this seasonality. All right, so what about weekly seasonality? Here is the seasonal chart going back over the last 20 years for the S&P 500. And we can see, in general, it gets pretty positive at the beginning of the year. You have the first week is positive, and then the last week of January, early February is positive, and into mid-February. But then we get a dip in late February and early March. And then in late March starts perking up, and there's April with those 2 strong weeks. And then we move forward, we can see June. There's a week in late June that is not very strong. There's a week in early August, I believe that is not very strong, late July maybe. And then you can see here in September a very weak week. But then look what happens when we turn the corner and get into the middle part of October. A lot of strong weeks over the last 20 years. So if you're interested in this video and the charts that I'm showing, I put together a report for subscribers on trendinvestorpro.com. And all these charts and more are in this PDF report. It's got over 20 charts because I cover every single month of seasonality. And I'm going to show January and February coming up here. And I also highlighted the turn of the month strategy, which involves the last 4 days of one month and the next 4 days of the following month. So here we can see basically would be bullish on the close of the 5th to the last day of the month and hold into the 4th day of the month. And that has a very strong bullish bias. If you just used that strategy, you would have had an 8.4% return, just trading 8 days a month and being basically invested 38% of the time in the S&P 500, 8.4% compound annual return. And so that's why I was expecting a bounce this week, because we were oversold and we were in this turn of the month period. But this report is also available to subscribers of trendinvestorpro.com. So here's the seasonal pattern during the month, and I've got the month of February here, and this is from 1980 to 2000. And you can see February starts out strong, then kind of plateaus, has a dip, and then has a bounce at the end of the month. But this changes when we look at the last 20 years. This is from 2001 to 2021. And it shows that February starts out weak and then gets a bounce into the middle part of the month and then weakens towards the end of the month. Now, there are a lot of cross currents going on out there. First of all, we're in a bull market. We've got an uptrend, but we became oversold after that sell-off the last week of January. And so that gave way to the bounce that we're seeing in early February. But if you look at the seasonal patterns, you can see that they're not so strong in February and into early March. And so that might mean we're going to be in for more of a rough period than a trending period. As you can see over the last 20 years, February starts rough, gets a bounce, and then ends rough. So here is the seasonal chart for January, and you can see January starts off with a boom, gets another little blip into the second week, and then sells off in the last 2.5, 3 weeks of the month there, and that's certainly what we saw this year. All right, so that concludes this video on seasonality. I hope you enjoyed it. Check out trendinvestorpro.com. If you'd like to know more, you can follow me on Twitter at Arthur Hill. And if you like this video, please give us a thumbs up and consider subscribing to our YouTube channel. Thanks again for tuning in and have a great trading day.